When a small business collapses, it rarely happens because the underlying idea was mathematically unprofitable. Most closures stem from two concrete errors: building a product no one is willing to pay for, or simply running out of cash. This split-screen graphic illustrates the difference. A business can be highly profitable on paper by sending out invoices, but still fail if it lacks the actual cash flow required to pay vendors and make payroll while waiting for clients to pay. To eliminate this financial guesswork, we are going to build the Business Survival Audit. This is a two-part diagnostic spreadsheet designed to identify exact points of failure before you spend a single dollar. Open a blank spreadsheet program. To complete this setup, you will only need a list of your estimated monthly operating expenses. Dedicating 10 minutes to building this framework right now gives you a verifiable cash roadmap, entirely preventing the conditions that cause sudden business closures. Let's begin. Step 1 is market validation. You must objectively prove that your target audience actually wants your product before you allocate capital to build it. Create your first spreadsheet tab and type out 3 column headers: target audience, competitor differentiator, and willingness to pay proof. Look closely at this highlighted column. Many new owners treat friends liking their idea as valid market research. That is not actionable data. Acceptable willingness to pay proof is strictly limited to 3 things: actual pre-sales, signed letters of intent, or precise price acceptance surveys from your target demographic. You must log at least one verifiable piece of proof in this column. Until that cell is populated, you are not permitted to move to the next step. By treating this checklist as a hard requirement, you eliminate the risk of pouring your initial capital into a flawed business model. Now that we have validated demand, step 2 transitions from market theory into operational reality. We need to track how your liquidity functions over a standard 90-day cycle. Create a second tab in your audit. Across the top row, map out columns labeled Week 1 through Week 12. Down the left column, build 2 major vertical sections: cash in for your paid sales and cash out for operational expenses like payroll and vendors. There is a non-negotiable rule for data entry here. You only enter revenue in the specific week the cash physically hits your bank account. You never enter it in the week you send the invoice. Building this specific temporal architecture forces you to stop managing hypothetical revenue and start managing tangible liquidity. We are looking for the payment gap, the hazardous delay between paying your operational expenses and actually receiving your client payments. To find it, create a final bank balance row at the bottom of your tracker. Set this row to mathematically subtract your weekly cash out from your cash in. Consider a realistic operational scenario. You send a large invoice in Week 1. Your payroll clears in Week 2, but the client's payment doesn't arrive until Week 4. The immediate consequence is visible in your timeline. In Week 2, your bank balance drops below 0. This specific red cell is the exact moment of death for most early-stage companies. Your Week 1 invoice proves you are profitable, but your lack of liquidity means you cannot keep the doors open to collect it. Scan your bank balance row for the lowest negative number. Copy that exact dollar amount to the very top of your document and label it Initial Capital Required. Isolating this negative figure provides data-backed proof of the minimum funding you need to bridge your payment gaps and scale securely. Step back and look at your completed framework. You now have a strict market validation checklist alongside a fully mapped, color-coded financial tracker. By structuring the data this way, you have successfully converted the abstract fear of business failure into a controllable mathematical system. To keep this system intact, establish a strict maintenance protocol. Open your cash flow tab and update your numbers every Friday afternoon. Executing this weekly habit is the only reliable way to ensure your bank balance row never unexpectedly drops into a fatal deficit. By permanently securing verified demand and mapping your future liquidity, you have systematically insulated your company against the core determinants of failure. Save your file and subscribe to the channel for our next operational guide.